Okay, dear students, let's start our third live revision class. Session is March 25. Let us quickly first discuss the remaining concepts of cost of capital. Then obviously we'll move to investment appraisal. Plus, towards the end of the class, there will be one or two announcement you can say or something I'll share relating to the, of course, AFM study. So you have to listen to that carefully and follow it also. Okay, students. So far in cost of capital, we have seen how to calculate KE, KD1 minus T, and KP as well. Okay. Now, let's discuss in case of diversification. How do we calculate risk adjusted WACC? Diversification means when you are making investment in a non-core activity. Diversification means when your business is going to do something new. That is diversification. Let's say we are making investment in a different industry. Okay. The question is, in case of diversification, the WACC which we calculate, that is a risk adjusted WACC. So what is the approach of calculating risk adjusted WACC in case of diversification? Let me first repeat again. Diversification means when you are making investment in a new industry, when you're doing something different, when you are making investment in non-core activity. Okay, now, whenever your company goes towards diversification, so step number one for calculating risk-adjusted WACC is to find beta asset of new industry. So after reading the question, as soon as you come to know that it's a diversification question on diversification, so your first step is to find beta asset of the new industry. Now, how to find beta asset of the new industry? Before we discuss that, we should know this. Beta asset is an ungeared beta. Beta asset only measures the business risk. Obviously, when you are making investment in a new industry, so in a new industry, your business risk will be different as compared to your existing industry. Now, how to find out the beta asset of the new industry? Rare chances are there that examiner might give you the beta asset of the new industry straightforward. Chances are very rare, I would say. So most of the time you have to calculate. Now, how do we calculate beta asset of the new industry? It's very simple. Examiner will definitely give you the proxy company in the new industry. Proxy company means, let's say your competitor in the new industry, the company which is similar to you, but they are already in the new industry. So what are we going to do? We'll take proxy company equity beta and you have to de-gear. You have to de-gear proxy company's equity beta to calculate beta asset. Beta equity, another name for the beta equity is a geared beta. More explanation to the beta equity. Beta equity is a two risk beta. It measures financial risk as well as business risk. Financial risk, a very simple interpretation of financial risk is financial charges, interest payment. So financial risk business only faces when there is debt in the business. When there is a loan in the business, then obviously you will face financial risk. And what financial risk does and who actually faces this financial risk? Actually, shareholders are the one they actually face financial risk. And what financial risk actually does, it actually fluctuates the return for the shareholders. Because when your company has taken the loan, so you have to make the fixed interest payment, no matter your earnings are good or bad, you have to pay the fixed interest payment. So obviously, from PBIT means operating profit, profit before interest and tax. Company will have to deduct the interest, no matter PBIT is high or low. Then we'll get profit before tax. Obviously, you have to pay the tax. Then there will be profit after tax. Now, from this profit after tax, company will have to decide how much dividend they are going to pay. Either they will be paying the dividend or not, how much, it's up to the company. And the shareholders, equity holders, they get dividend from the company. Now, the problem is, before the shareholders, they get dividend from the company, company will have to pay interest. So after the interest payment, obviously we don't know how much profit before tax will be there. So the point is, this interest payment actually creates fluctuations on the return of shareholders. That is why always remember one point. When your company increases the debt, then it increases the financial risk. And when your financial risk increases, and who faces the financial risk? Shareholders. Your equity beta will increase. And when your equity beta increases, KE will increase. Obviously, shareholders, they will demand higher rate of return. So when loan increases, financial risk increases, equity beta will increase, and then definitely KE will increase. Because shareholders, they demand higher rate of return. Okay. When we say business risk, a very simple interpretation of business risk is actually fluctuation in operating profit. Profit before interest and tax is an operating profit. Normally, businesses, they do not have the stable operating profit. It fluctuates. So that fluctuation is the business risk. Because if it is increasing every year, then it's excellent. But we know that you're running a business, there's a possibility that every year you will not be having the same operating profit. So operating profit can increase, but it can reduce as well. So now the concept is, when you are running a business, you have to face the business risk. But financial risk will only arise when there is a loan in the business. Okay, now beta asset, another name for the beta asset is ungeared beta. The beta which does not have the gearing. Ungeared beta. Now always remember one concept, and that will also helps you while solving the question, so that you should not be making any mathematical error. And this is one of the deadly sin in AFM as well. If you make that mistake, so it becomes difficult to tolerate for the market. What is that mistake? You need to know one thing. Equity beta will always be higher than beta asset. Always. Why? It is a two risk beta. And this is one risk beta. So logically, two risk beta should be higher than one risk beta. But you need to know one more interpretation. What is that? If someone says, what if beta asset is equal to beta asset, then actually, if you come across a question where equity beta is equal to beta asset, then interpretation is logically, technically, then equity beta is itself a beta asset. Another interpretation is this business is 100% equity finance. Because when your business is 100% equity finance, then logically there is no debt. Obviously, when there is no debt, there is no financial risk. When there is no financial risk, then obviously there's no difference between equity beta and beta asset. But normally, when business is there, company is there, they do take loan as well. So it means beta equity will always be higher than beta asset when there is a loan in the business, and you will normally see loan definitely will be there in the business. So make sure mathematically when you are solving a question, if you're, for example, you're converting beta asset to beta equity, so you should be mentally prepared whatever the answer comes must be higher than the beta asset. And when you are converting beta equity into beta asset, then you should be mentally ready whatever the answer comes, it should be lower than equity beta. Now, come here. In case of diversification, we have to calculate a risk adjusted WACC. How do we calculate? The step number one is to find beta asset of the new industry. How to find the beta asset of the new industry? Examiner will definitely give you the proxy company, means your competitor in the new industry. We have to take equity beta of our competitor. D-gear means ungear. D-gear means ungear. D-gear means ungear. You will get beta asset. Equity beta is a 2 risk beta. Beta asset is 1 risk beta. So logically, 2 risk beta must be higher than 1 risk beta. Now, the question is how to de-gear. How to de-gear equity beta to calculate beta asset. So let me write the formula for you. We have an asset beta formula. The asset beta formula. Beta asset is equal to equity beta multiply by market value of equity divided by market value of equity plus market value of debt 1 minus tax rate plus beta debt into market value of debt 1 minus T, market value of debt 1 minus T, market value of equity. Actually, beta debt shows the risk of default. And normally, I'm saying normally, I'm not saying always, but normally in AFM, we assume default risk is 0. Means company will pay the liability on time. So when beta debt is 0, so the formula changes and it becomes simple. Beta asset is equal to equity beta into market value equity plus market value of debt 1 minus tax rate. Now please listen carefully. We have to take proxy company equity beta, market value equity of proxy company, market value of debt of proxy company 1 minus T. By putting all the values of proxy company here, you will get beta asset. Let's say you have calculated beta asset. Now, what is your step number 2? Now, this beta asset, let's say we have found the beta asset of the new industry. So we'll take the beta asset. Now we are going to gear up with own financial gearing, with our own company's financial gearing, on financial gearing. Now this will give you equity beta. So here what I'm doing, use proxy companies data. That is proxy companies financial gearing and proxy company equity beta, because I need to find beta asset. Now I have calculated the beta asset. I have to now gear up with our own financial gearing to get beta equity. Once, let's say you have managed to calculate equity beta, by using CAPM, we can calculate KE. Now the question is, how to utilize this asset beta formula to calculate equity beta, because we know that we have to solve the question on a spreadsheet. So how to put the values so that I can solve in a cell. Very simple. Now I want equity beta to become subject. Look at this. Beta equity is equal to beta asset multiply by market value equity plus market value debt 1 minus x divided by market value equity. Obviously, very easily, we can put all the values in a spreadsheet cell. All these values, beta asset, market value equity, market value, you can easily put in a cell. But please look at both the formula. Both formulae, they are different. In the first one, the subject is beta asset. In the second one, the subject is equity beta. Now here, we'll be using own financial gearing. So equity beta is equal to beta asset into market value equity plus market value debt 1 minus tax rate divided by V. Obviously, after calculating the beta equity by using CAPM, capital asset pricing model, we can easily calculate K. So never forget the approach of calculating risk adjusted WACC in case of diversification. What is the step number one? Step number one is to find beta asset of the new industry. How will you find the beta asset of the new industry? Obviously, your examiner will give you the proxy company's information. Simply your competitor in the new industry, which is already there. So what are we going to do? We'll take proxy company equity beta, D gear, calculate beta asset. Once you have calculated the beta asset, then we'll be using our own gearing to gear up that beta asset to calculate beta equity. Once you have calculated the beta equity, then the rest is straightforward. Now, another scenario. This is the situation where we are diversifying. Now, let's calculate approach of calculating logically companies back when company is already diversified. Now, please listen carefully. Now, the scenario is different. Let's say examiner has given you the question where company is not diversifying, the company is already diversified. Let's say the company is already operating in automobile industry as well as, let's say, in cement industry. So they are already operating in two industries. There's a possibility they are already operating in three industries. Simply examiner is asking you to calculate WACC of a diversified business. Logically, when you are calculating a WACC of a diversified business, that is considered as a company's WACC. It's not a risk-adjusted WACC. Logically, we calculate risk-adjusted WACC when there is a diversification. Then we'll go for risk-adjusted WACC. And second concept for the risk-adjusted WACC is in case of overseas investment appraisal. In case of overseas investment appraisal, no matter you will be doing the same business in the overseas, still logically, technically, I need risk-adjusted WACC for overseas investment appraisal. Because even you are doing the same business in a different country. So obviously the economic environment, the legal issues, the cultural differences, and so many other differences are there. So definitely the business risk will not be same, even though you're doing the same business, but in a different country. That is why logically, in case of overseas investment appraisal, always we need risk adjusted WACC. The way back in the past paper, there's a question on overseas investment appraisal in which examiner has deliberately given us the company's WACC rather than risk adjusted WACC. So in that question, students were required to mention in their answer that instead of company's WACC, there should have been a risk adjusted WACC. And by mentioning this thing, you could have scored 1 mark. So whenever you come across a scenario which is very different from your understanding, but make sure your understanding has to be really good, okay? So it is very different from your understanding, then you should mention, like students, they should have mentioned in the question that in case of overseas investment appraisal, it is far more logical to use risk adjusted WACC rather than company's WACC or current WACC. Okay, now let's say we are solving a question of WACC where business is already diversified. Now, what are the steps? Step one, to find beta asset of each business. Step one is to find beta asset of each business. I'm assuming that your company is running two businesses. There's a possibility of three as well. But let's say they are running two businesses. Okay. To find beta asset of each business, assuming business one beta asset is, let's say, 2. Business 2 beta asset is, let's say, 1.6. Another question is, sir, how to calculate beta asset of each business? Or you can say beta asset of each industry. Because you are running a business in different industries. Okay. One possibility, examiner might give you the straightforward information. Otherwise, your examiner will definitely give you the proxy company's information in each industry. So it means to find beta asset of each business, to find beta asset of each industry. So one possibility, let's say examiner might give you the straightforward information. Let's say examiner has directly given you the beta asset of business one is, let's say, 2. For business 2, examiner might have given you the information of proxy company equity beta and gearing. So what are you going to do? You will take proxy company's equity beta d-gear to calculate beta asset. But the main point is, whenever you come across a question where company is already diversified, you are calculating a company's WACC. So you have to focus on one point. The step one is to find beta asset of each industry, to find beta asset of each business. Let's say you have managed to calculate beta asset of each business. Now what to do? Step 2 is extremely important. Step 2 says calculate weighted average beta asset. Can anyone give us alternative names for the weighted average beta asset? Actually, there are two alternative names are available for weighted average beta asset. One is very old, but another one is not old. So is there anyone who can give us alternative names for weighted average beta asset? I'm waiting. Let's see who will give us the answer. So weighted average beta asset is equal to business one beta asset. Percentage shows the weights plus business 2 beta asset into percentage. Anyone? No one has given so far any alternative names for weighted average beta acid. Students, is there anyone who can give us any alternative names, but obviously logical one, for weighted average beta acid? You have 10 more seconds to answer, otherwise I'll tell you. Okay, so far there's no answer. Why? A very old name for the weighted average beta acid is proxy beta acid. Proxy beta acid. There's one more name. That is beta acid company. So, but obviously you should be using weighted average beta acid. I'm just giving you for the sake of knowledge. A very old name, that is proxy beta acid. Another name is beta acid company. Okay. Weighted average beta acid is equal to business 1 beta acid into percentage means weights and business 2 beta acid into percentage means weights. Now listen carefully. Now listen and listen carefully. I'm giving you very important concepts. Now the question is, what about these percentages? What about these weights? Now listen. In AFM, weights will be given in the question. But obviously, examiner is going to give you the hint for the weights. But here I'm giving you a very important concept. The concept is, let's say you have calculated beta acid of each industry. Now you have to calculate weighted average beta acid. So from where I'm going to get the weights? So answer is, in AFM, weights will be given in the question, but obviously examiner is going to give you the hint for the weights. Hint will be there. Now, here I can still help my students, but please listen what I'm saying right now. I can still help you here. And the help is, I can just give you the possible options for the weights. Then what are the possible options for the weights? I'm not saying these are the only option which I'm going to discuss with you. I'm saying that they are the possible option. Most of the time you will see one of them, but still examiner can give you any other information. But the main concept is weights will be given to you. Now, what are the possibilities? For weights. Possibilities. One possibility, revenue of each business. That's a possibility. Then examiner has given you the information of revenue of each business, so I'll be using that. Another possibility, investment in each business. If your examiner says the 40% of investment is in business one and 60 is in business two, okay, I'll use that. There's a third possibility as well. Proportion of market value of equity relating to each business. For example, let's say your examiner says that 25% of equity is in business one. That means 75% is in business two. But again, I'm just saying these are the possibilities. That examiner might give you the revenue of each business, investment in each business, proportion of market value equity, that how much market value equity is in business one, how much is in business two. So obviously, if examiner gives me the information, how much market value is in business one, then obviously rest is in business two. But these are the possibilities. There's one more possibility. Examiner might give you the information like this. Let out of total asset, for example, examiner says 30% to assets they are in business one, so obviously 70% they are in business two. The main concept is examiner will give you the hint for the weights. Okay, now I'm writing etc. Other options are also possible. Step one is to find beta asset of each industry. Let's say somehow you have managed to calculate that. In step two, weighted average beta asset. And another name for the weighted average beta asset, which is very famous, I would say, is beta asset company. Now, step three. Let's say you have calculated weighted average beta asset. Or another name is beta asset company. Now, what I'm going to do after step two, we'll take beta asset company and gear up with own gearing, obviously. On financial gearing. That will give you beta equity company. And we know that how to gear up. Once you have calculated equity beta company, then obviously by using CAPM, we can very easily calculate KE. So what are the steps of calculating WACC of a diversified business? Step one, to find beta asset of each industry. Step two, to calculate weighted average beta asset. Another name is beta asset company. After you have calculated beta asset company, gear up that beta asset company with your own financial gearing to calculate equity beta company. And after calculation of equity beta company by using CAPM, you can calculate KE. So this is the approach of calculating WACC of a diversified business. Okay, now one more concept, very important. And we'll be doing a past paper question on that concept as well. What is the name of a concept? Let me tell you. First of all, WACC formula. Let's say market value equity. That is V plus VD. If you have preference shares, which normally we do not have in our AFM, but if you have preference shares, take the VP as well. So K V plus KD 1 minus T, market value debt, market value equity, debt, and preference shares. Then finally, you will have KP, VP, or when there is no preference shares. Formula becomes, I would say, a bit simple. WACC is equal to K market value equity plus market value debt, then KD 1 minus T, market value debt, equity, and debt. Okay, now. Normally, I'm not saying always, but normally, in AFM, in WACC question, normally VD, normally market value debt will be given to you. Normally, I'm not saying always, I'm saying normally it will be given to you. Okay, now, question. What if Market value of debt is not given. Obviously, if market value of debt is not given, then you have to calculate market value of debt. That is valuation of debt. Valuation of debt means market value of debt. Valuation of debt means market value of debt. Simply, what is the market value of my debenture at a stock exchange? What is the market value of my bond at a stock exchange? I really want to find out if it is not given. So the question is, how will you calculate market value of debt? Valuation of debt. Let me tell you. First of all, I always say that this valuation of debt or market value of debt, the calculation of market value of debt, it depends on one concept. What is that concept? The concept is how much return your company is giving to the debt holders and what market is providing the return on similar bonds. What do you mean by this? Listen. Number one, coupon rate means cash interest rate. Coupon rate means cash interest rate. Cash interest rate means how much company is paying a return every year to the debt holder, to its debt holders. Assuming coupon rate is 10%. Let's say your company's bond is having a coupon rate 10% and similar bond, similar bond means if your bond is having a maturity period of 4 years, so similar bond is having a maturity period of 4 years, the whatever is the credit rating of your bond, the similar bond is also having the same credit rating. That is similar. If your company is having a coupon rate of 10% on its bond and the similar bond in the market, it has a 12%, means your company is paying less return as compared to the market. Simply market interest rate is more than what your company is paying to your debt holders. If this is the case, then logically we can say that your debt holders, they are having a disadvantage. They're facing a disadvantage. Now, what is that disadvantage? Please try to understand. Your company is paying 10%. On the other hand, on similar bonds, market is paying 12%. So they are getting return lower than what is the return on similar bond in the market. If this is the case, they are facing a disadvantage, and that disadvantage will reflect in your market value of debt. And logically, your company's market value of debt will be lower than par value. So in case number one, when your company is paying coupon 10% and the similar bond in the market, they are paying 12. So obviously there's a disadvantage for your debt holders. The disadvantage is they're getting lower return. So that will reflect, and where it will reflect in the market value of debt. And logically, the market value of debt will be lower than par value. Okay. Second possibility. Assuming coupon rate is 10% on your bonds, which is more than similar bonds in the market. Let's say similar bonds in the market, they are paying 7%. If it is a scenario number two, then your debt holders, they are having an advantage. The advantage is your company is giving them the return more than the market. If this is the case, then logically, market value of debt will be more than par value. Third possibility, If the coupon rate your company is paying 10, and let's say the similar bonds also have a 10%. Similar bonds in the market, they are also paying 10%. If it's a case number 3, then your debt holders, they're not having any advantage, they're not having any disadvantage as well, because they are getting the same return which is in the market. If this is the case, then market value debt will always be equal to par value. Now, very important concept I want to discuss now. What is that? I have discussed 3 options: 1, 2, and 3. Now listen, your debt might be having a market value lower than par, might be having a debt market value more than par, could be equal to par. Now listen carefully. These 3 outcomes are only possible. These 3 outcomes are only possible when bond is fixed rated. What do you mean by fixed rated? Means your company's bond is not having a variable interest rate. Variable interest rate means whatever is in the market interest rate will pay the same thing. If you have issued a bond which is having a variable interest rate, then always par value and market value will be equal. Why? Because variable interest rate means you are saying I'll pay the same interest rate which is in the market. So when you will be paying the same interest rate which is in the market, so your debt holder will not have any advantage, they will not have any disadvantage. Here, the 3 possibilities are possible. The condition number 1 is when bond is fixed rated, the interest rate is fixed. This is condition number A. Condition number B is logically redemption is at par value. Because if you are redeeming the bond at premium, so premium is itself an interest. So logically, students, listen carefully. Either your bond could have a market value more than par, less than par, equal to par. All these 3 possible options, they will only exist only when logically the bond which your company has issued, it has a fixed interest rate, and the second is redemption will be at par value. Redemption will be at par value. Then there are 3 possible options. Otherwise, obviously, these 3 options will not exist. For example, if your company has issued a variable interest rate, so always, in case of variable interest rate, it will always be market value debt equal to par value. Now, so logically, you need to know these 3 possible options, they do exist, but prerequisite condition for 3 possible outcomes are bond is having a fixed interest rate and the second is redemption is at par. Now, how do we calculate? Now, let's discuss numerically. How do we calculate market value of debt? Market value of debt. Basically, the market value debt is equal to present value of all future cash flows. When we say future cash flows, I'm talking about interest and principal. Plus something, I'll come to that. Market value debt is equal to present value of all future cash flows. So number 1 is, when we say present value, so we need discount factor. For calculating present value. Discount factor will be cost of debt. Cost of debt means KD. KD means, if you recall the previous class, YTM, and I did mention many times, in AFM, the first priority is YTM. So logically, for market value debt is equal to present value of all future cash flows. When we say present value, we need discount factor, and the discount factor will be cost of debt, KD, that is YTM, yield to maturity. And we know that. How do we calculate YTM? Number one, I'll see what is the maturity period of your bond. Assuming it is 3 years, so I'll check what government is offering at 3 years. So whatever government is offering at 3 years, that will work as RF. Plus we will add CRP, credit risk premium, and CRP will be given to you in exam. And what is the language of writing CRP, credit risk premium? Another name for the credit risk premium is default risk premium. Default risk premium. Basically 100 basis points. They're equal to 1%. So YTM is equal to RF plus CRP. Another name for the CRP is DRP, default risk premium. And 100 basis points, they're equal to 1%. They're equal to 1%. Okay, now let's see. Assuming we are calculating a market value of debt, I'm just assuming, okay? And let's say the maturity period is, let's say 4 years. If the maturity period is 4 years and we need to calculate market value of debt. So how will you calculate? Very simple. T1, T2, T3, T4. Cash flows. Here I'll take interest, annual interest. No 1 minus T, okay? There's no 1 minus T because we are just calculating market value debt. Interest. Now the last point is very important. Interest plus the redemption amount. Interest plus redemption amount. And when we say redemption amount, I always say one thing for the redemption amount. For the redemption amount, students, I always say read the question carefully. You have to read the question carefully because for the redemption amount, there are possibilities. Now, what are the possibilities for the redemption amount? One, redemption could be at par value. And let me tell you, nothing is mentioned. We always assume redemption is at par value, and it could be mentioned as well. Redemption could be at premium. But obviously, if the redemption is at premium, it will be mentioned in the question. This is something which we cannot assume. Nothing is mentioned, I'll assume at par value, which is okay. But for premium, I cannot assume it. It will be mentioned. So the second possibility is redemption could be at premium, but obviously if it is at premium, it will be mentioned in the question. Third possibility for the conversion redemption amount is conversion value. Third possibility for the redemption amount is conversion value. Now listen carefully. Students, the issue of conversion value only arises when number one, the given bond is a convertible bond. And number two, at redemption, conversion value is more than the redemption amount. At maturity, conversion value is more than the redemption amount. Obviously, if conversion value is more than the redemption amount, then bondholders, investor, they will go for conversion rather than redemption. So conversion value is only possible. Number one, the given bonds are convertible bonds. And second, conversion value is higher than the redemption amount. Let me just write the fourth possibility, which I have never seen in AFM past paper, but let me write at discount. Again, if the redemption is at discount, it will be mentioned in the question. And your discount factor will be YTM. So obviously by using NPV shortcut, you can easily calculate market value of debt. And the market value of debt is equal to present value of all future cash flows. Okay, now let me just show you the shortcut how to calculate market value of debt. We have to go to Excel. Let me share that. Just a minute. Oh, no, that's too much. Just a minute. I hope everyone can see this spreadsheet Excel. Let's say we are calculating market value of debt. Time 1, 2, 3, and 4. Cash flows. I'm just assuming, okay, it is 10, 10, 10, and let's say 10. Plus, I have to take the redemption amount, assuming the redemption is at 20% premium, so 120. Now, YTM. Let's assume that YTM is 7%. Okay. We actually need market value debt. So what to do? Is equal to NPV. Okay. I'll take the rate, comma, take all the values, shift, and then right arrow, bracket close. Students, I'm getting 125.42. I'm getting the market value. I hope this shortcut is clear to everyone. Yes or no, please quickly reply. Students. Let's see what our students they are saying. Yes, it is clear. That's great. Let's go back to OneNote. Okay. Obviously, we'll be discussing only those shortcuts which are available in exam. There's no point of discussing a shortcut which is not available. That's obviously useless for us. Now, let me tell you. Actually, I would say there's one more variety for calculating market value debt. That variety you need to know what is that. Even though in that variety, I have covered the article as well. Obviously, you have not seen that video yet. It comes towards the, I would say, end of the session. But we can discuss. What is that? Let me explain. Assuming, I'm just assuming, okay? Let's say your examiner has given you the information like that. ABC company. They're having 10% bonds. Let's say the par value is $100. Assuming maturity period is 3 years. Okay. Now, examiner says time T1, T2. T1 means first year, T2 means second, T3 means 3 years. Okay. Government bonds. Okay. Let's say your examiner says there's a government bond one, which is having a maturity period of 1 year. Okay. Maturity, let's say year one. This bond two of government, maturity period is, let's say, 2 years. This bond three of the government, which is having a maturity period of 3 years. Let's say examiner has given you the information of bond one, maturity period is 1 year, bond two, maturity period is 3 years, bond three, maturity period is 3 years. Okay. Here comes the yield on government bond. Government bond yield. Yield means return percentages. Let's say it is 5%, it is 5.2%, 5.5%. Okay. CRP for ABC company. Let's say in case of year one, the credit risk premium, I'm just assuming, is 20 basis points. Here it is 40 basis points. Here it is 50 basis points. The requirement is calculate market value of bond. Okay. Now, how do we calculate market value bond now? It's very important. Most of the time, you will be having only information of the government bond which matches your company's bond maturity period. But here the scenario is different. Here examiner says there are 3 bonds of the government, 1, 2, 3. All are having a different maturity period, different government yield, and plus examiner has given you the information of credit risk premium also according to the time period, 20 basis, 40 and 50. And they are, CRP actually relates to your company because obviously your company's bond will be riskier than the government bond. Now, how to calculate market value of bond? Now, please, you have to listen carefully. If you are getting information like this, which I have written, and obviously once you will see the inshallah article on this topic as well, so automatically you will be having a really good grip, but this class will help you also. Now, actually YTM will be different every year. Now it will not be same. What I'm going to do, let me show you. T1, T2, P3. I'll take government yield. Government yield, and the proper name is government yield curve. You will obviously see the article on this yield curve as well. Don't worry at all. Government yield curve percentages is 5%, 5.2, and 5.5. We will add CRP into that. CRP, credit risk premium. Another name for the CRP is default risk premium. 20 basis point means 0.2%. Because 20 divided by 100. 40 basis point means 0.4%. 50 basis point means 0. Now you will get YTM for each year. 5.2%, 5.6%, and now how will you calculate market value debt? That is very interesting. Market value of 10% bonds time T1, T2, T3. Let's take the cash flows. As I already mentioned that if examiner does not say anything about the redemption amount, then we always assume redemption is at par. 10% of 100 is 10. Cash interest is 10. And the last year, can I say 110? Nothing is mentioned. We always assume that redemption is at par value. Nothing is mentioned. We always assume that redemption is at par value. Okay. Now, Y team is not same. It is changing every year. Here it is 5.2%. So it means for calculating the present value, Y team is changing every year. So it's okay, no issue at all. 5.2% means what I'm going to do, 1.052, can I say power minus 1? 5.6 means 1.056 minus 2. Here, it will be 1.06 minus 3. Let me use the calculator. And I want you guys also use the calculator. I'm getting 9.5. 8.968. 92.358. Add all of them. Market value of bond. 9.5 plus 8.968 plus 92.358. I'm getting 110.826. The question is how we are going to solve this on the spreadsheet. Obviously, everything will be same like this. Now we cannot simply apply. Now shortcut NPV formula is not possible. Why shortcut NPV formula is not possible over here? Because the YTM is changing every year. Is this clear to everyone that you cannot directly apply now NPV exactly the same way you have to solve on the spreadsheet? 10 multiplied by 1.05 to power minus 1, then power minus 2, power minus 3. Why because look at the data is in front of you. You cannot apply NPV shortcut. Is this clear to everyone that we cannot apply NPV shortcut? Please comment on that. If question comes like that, We cannot apply shortcut of NPV. Is this clear? Please comment so that we can proceed. Clear. Okay. Now, the question gets, I would say, more interesting when what your examiner does. Actually, if your examiner is asking you, instead of calculating market value of debt, if your examiner is asking you to calculate government yield curve percentages, these percentages. Repeat. Let's say examiner has changed the question. Instead of asking you to calculate market value of debt, examiner says, no, 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 no. Examiner says, calculate. Let's say requirement 1 is calculate government yield curve. Then the requirement 2 is calculate market value of the bond. And then the requirement 3 is calculate YTM for cost of capital. Repeat, please listen to me carefully what I'm saying. Examiner says, requirement 1, calculate government yield curve percentages, step 1. Second, market value of bond. Third, now examiner is saying I need YTM for cost of capital. Okay. Let me just go for that. Now, how will you calculate government yield curve for every year? Now, this is very important. For calculating government yield curve of each year, obviously you need to know one concept. The name of the concept is market value of debt is actually equal to present value of all future cash flows. Market value of bond, market value of debt is equal to present value of all future cash flows. Okay. Let's say we have government bonds 1, 2, and 3. Redeemable 1 year, the second bond in 2 years, and the third bond is in 3 years. Coupon rate means what government is offering 9%, 7, and 6. Market value, current market value of each government bond is $104, 102, and 98. Okay. Let's say credit spreads for ABC company. Rating and maturity as well. 1 year, 2 year, 3 years. If the rating is AA, examiner will let us know what is the rating. If the rating is AA, then it is 18 basis points. The spread is in basis points, which we have already discussed that 100 basis points. 100 basis points. 100 basis points are equal to 1%. 18, 31, 45. If the rating declines from AA to becomes BB, then 54, 69, 86. Okay. Let's say existing rating is AA and new rating is going to be BB. You can see that when the rating reduces, then CRP, credit spread, increases. When the rating declines, becomes bad, I would say, then credit risk premium will increase. Okay. Required. The requirement says calculate government yield curve percentages, bond one, make it this. Government yield curve percentages for year 1, year 2, and year 3. Second, market value of ABC company's bond. Let me give you the information of the ABC company bond. That ABC company bond, 8% bond. Maturity period is 3 years. And redemption is at 2% premium. So first of all, we need to calculate government yield curve percentages for year 1, 2, 3, and then market value of company's bond, 8%, maturity period is 3 years, and redemption is at 2% premium. Market value of 8% bonds on AA rating and BBB rating. So it means we have to calculate market value in both the cases. Third, YTM for WAC on AA and BBB rating. So these are the few, I would say, requirements. First, we have to calculate government yield curve rates for first year. Simply, what is government offering on bond 1, 2, and 3? But we have to calculate yield curve. Let's come here. The data given to us will help us. Bond 1, coupon rate is 9%, but it has a market value 104. Bond 1 is having a maturity period of only 1 year. Please, student, focus carefully. How to deal with that? Bond 1 of government, of course. Market value is 104. They have given us is equal to. Bond 1 is having a maturity period of only 1 year. And the coupon rate is 9%. Nothing is mentioned. Par value is always 100. Now listen. Bond 1 is having a maturity period of only 1 year. So can I say in 1 year time, total cash flow will be 109. Please first comment on this 109. 100 is the redemption amount and 9 is the cash interest. Is this clear? 109. Multiply by 1 plus R1 minus 1. Actually, this is present value of cash flows. First student, what I have written, I want clarity from you guys. Is this clear to everyone? 104 is equal to 109, 1 plus R1 minus 1. Yes or no, please comment on that. Of course, after that, we can go ahead. I'm waiting, students. Bond 1 is having a maturity period of only 1 year. Obviously, if it has a maturity period of only 1 year, then maximum cash flow in 1 year's time is going to be 109. And I want to calculate actually yield of first year, that is R1. Students, I'm waiting for the comments. Is this clear so that we can go ahead? What I've written. I hope I'm audible to everyone. Okay, now the results are coming. So, what is the issue? I really want to ask. How will you calculate the present value? How will you calculate present value? Let's say we know that bond 1 is having a maturity period of 1 year. In 1 year time, the cash flow will be 9. That is the cash interest rate plus the redemption amount is 101. Redemption amount is 100. So the total amount will be 109. And you will discount this 1 plus R1, which I don't know, minus 1. Here you will get a market value, which examiner has given you 104. Check this now. Bond 1 is having a maturity period of 1 year. Okay, it is clear to everyone now. Okay. Bond 1 is having a maturity period of only 1 year. And I don't know the discount factor. Obviously, examiner has given me 104. So definitely 104 is a present value. So what is the discount factor? That is what I really want to calculate. What was happening in a very first example, if you come here, look at this one. In this question, the government yield percentages, they were given to us. Now examiner is asking us to calculate these percentages. Okay, now come here. Bond 1, maturity period is only 1 year. I need to calculate this R1. So please, you have to be little bit good in maths, of course. 104 is equal to 109 divided by 1 plus R. We can write like this as well. Yes or no? Is this clear to everyone? If it is a negative sign, when it comes in the denominator, the negative sign becomes positive. Now, I really want you guys to use the calculator. What is R1? Now, 1 plus, keep watching, R1. It is in the denominator. Multiply by 104 is equal to 109. So 104 comes here. Keep watching, please. 1 plus R1. Now, logically, R1 is equal to 109 upon 104 minus 1. Whatever comes multiply by 100 will give you R1 percentage. So please, student, now use your calculator. What is the R1 percentage? I'm getting 4.807. So with a little bit rounding off, you can make it 4.81. Little bit rounding off. Yeah, 4.8 is perfectly all right. Is this clear to everyone? 4.81% or 4.8? And please understand it nicely because you have to solve this on the spreadsheet. 109 divided by 104 minus 1, whatever comes in 200, that is giving you a percentage 4.81%. I'm waiting, students, if it is clear, so let me know. So we can go for R2. This is R1. Now let's go for R2. Now listen carefully. Bond 2 is having a maturity period of 2 years. Bond 2 Bond 2 is having a maturity period of 2 years. Coupon rate is 7%. Market value is 102. Now keep watching. Market value is 102. Maturity period is 2 years. So in first year, there will be a cash interest rate of only 7. Cash interest will be 7. Multiply by 1.0481 minus 1 because first year yield, I know that. But in the second year, there will be interest, which is 7, and the redemption amount 100. It will be 107. And this 107 simply you can say divided by 1 plus R2 and the power 2. How did I get this 107? 7 is the cash interest and 100 is the redemption amount. Obviously, in the second year, we have to bear this redemption amount as well. First of all, student, what I have written is this clear to everyone? Market value of bond 2 is 102 is equal to present value of all future cash flows. First year, there will be only interest 7. The maturity period is 2 years. So in the second year, there will be interest 7 and the redemption amount 100. And for discounting 107, I have to take power 2. Is this clear? What I've written first. After that, we can proceed. Please comment on this. Or a student can write like this as well. This is the same thing. If someone writes like this, 1 plus R2 minus 2. Students, please comment on that. I'm waiting. This is year 1 cash flow and this is year 2 cash flow. And this is discount factor of the second year. And we need to calculate R2. Now I want everyone to use your calculator and give me R2. I want everyone to utilize your calculator, whatever you do. I'm waiting. I need R2. Please attempt this. I need percentage of R2. Okay, student, let's solve together because I've seen number of students are giving different answers, even though the question is same. Okay, now first come here, this one. Please look what I'm doing. Market value of bond, which is this, is equal to interest plus redemption amount. Am I right? Interest plus redemption amount. 1 plus R1. Keep watching. The final. How did I calculate R1? So basically R1 is equal to 1 plus redemption amount. Oh, sorry. Interest plus redemption amount. Can I say divided by market value bond? Minus 1. Why I'm writing like this? Can I say this will help us when we'll be solving this on spreadsheet? In case of R1, the formula is 1 plus interest plus redemption amount divided by market value bond minus 1. Obviously, this entire thing can easily be, you can put into the spreadsheet cell. Interest plus redemption amount divided by market value bond minus 1. Whatever comes multiplied by 100 is, or directly just click the percentage sign, you will get the answer in percentage. This is R1. Now come here for R2 as well. Number one, student calculate the present value of this. Let me use the calculator. 7 multiplied by 1.0481 power minus 1. I'm getting 6.678, so make it 6.68, no issue at all. Keep watching, please. Then finally, I have to write a formula as well, so that in the spreadsheet, we should not have any issues. 6.68, when I'll bring this 6.68 to the other side of is equal to, then sign changes, becomes negative. So 102 minus 6.68. Okay, now keep watching what I'm doing. I just want to make a formula so that we can solve in the spreadsheet as well. Keep watching, please. I want this power 2 sign should be removed from here. So logically, I have to take a square root on both the sides. Repeat. If I want this square sign to be removed from here, I have to take square root both the sides. Please keep watching. If it is 2, what do you have to do? 1 upon 2. Mathematically, the 2 and 2 will be cancelled out. So keep watching what I'm going to do. R2 is equal to minus 1. And 1 upon 2 means, students, can I say 1 upon 2 means power 0.5? Yes or no? Keep watching. R2 is equal to interest plus redemption amount market value of bond minus present value of year 1 cash flow power 0.5 minus 1. Is this clear what I have written? Now, obviously, very easily we can calculate R2. 102 minus 6.68. In the denominator, I'm getting 95.32. 107 divided by 95.32. Whatever comes, take the power 0.5. Students, I'm getting 5.949. So make it 5.95%. Is this clear to everyone? Yes or no? Please comment on that. Now, third year, bond 3. Bond 3. What is the market value of bond 3? 98. And coupon rate is 6%. Market value 98. Coupon rate is 6%. 6 multiplied by 1.0481 minus 1. 6 into 1.0595 minus 2. And the last year 106 divided by 1 plus R3 power 3. Now, students, I'm giving you 2 minutes. I want everyone to calculate R3, please. Then we'll make a formula as well, no issue at all. I want everyone to calculate R3. Please attempt this. Okay, students are giving the answers, and the good thing is answers are correct, mashallah. 98. The present value of first year is 5.72. Second year present value is 5.35. Now, what will be the formula? So actually 98 minus first year present value minus second year present value. Now just let me just write a formula so that from 98, you just need to deduct this. We'll deduct, no issue at all. 106, 98 minus the present value of first year minus the present value of second year. It is, if it is 3, the power is going to be 1 upon 3 minus 1. Great. 1 upon 3 means R3 actually is equal to interest plus redemption amount, market value of bond minus present value of cash flow year 1 minus present value of cash flow year 2. 1 upon 3 means 0.333 minus. I hope it is clear to everyone. And R3 we are getting 6.83%. R3 we are getting 6.83%. R3 we are getting 6.83%. Is this clear to everyone? You have to use the calculator. Without calculator, you cannot get it. Who says the market value is 106? Market value is 98. Look at the formula. 106 is representing interest plus the redemption amount. Look at this, the market value is 98. Who says the market value is 106? Please. Did you get this point? Got it? Yes. So market value is 98. Look at this market value bond, which is 98. Market value of the bond is 98. So students, you have calculated government yield of year 1, year 2, and year 3. Now, after that, the next requirements, they are very, very easy. Not difficult, I would say at all. Okay, this is done. Market value ABC company, 8% bond, maturity period is 3 years, redemption is 2%, but you have to calculate market value bond 2 times. When the rating is AA and when the rating is triple B. Let's see. First, we have to calculate YTM of each year. Government yield curve percentages. First year it was 4.81%, 5.95 and 6.83. Now simply add CRP. At AA, the CRP is 18, 31 and 45. 18 means 0.18%. 31 means 0.31%. 45 means 0.45%. YTM will be 4.99, 6.26, 7.28. Now very easily we can calculate the market value. T1, T2, T3. Cash flows, obviously power value is 100, 8, 8 and 110. How did I get this 110, students? How did I get this 110? Please comment on that. What is written for the redemption amount? Can I say the redemption is at 2% premium? No, redemption is at 2% premium. So it becomes 102. 102 plus 8 interest 110. So the first year discount is 1.0499 minus 1. 1.626 minus 2. Then 1.728 minus 3. Present value 7.62, 7.09, 89.09. Simply add all of them. I'm getting 103.8 market value. We have to recalculate the market value because examiner has asked us to calculate the market value on both the ratings, AA and triple B as well. Rating triple B. Again, we have to calculate YTM. Government yield curve percentages 4.81% we have calculated, 5.95 we have calculated, and 6 point. Credit risk premium. Credit risk premium, credit risk premium. Students, it is 54 basis points, 69 and 86. $54 means 0.54%. 69 means 0.69% and 0.86%. I'm getting 5.35%, 6.64%, and 7.69. YT. Now, very easily we can calculate market value of bond. T1, T2, T3. Just 1 minute break. Azan is sounding. Just 1 minute. Okay, cash flows. Students, cash flows will be 8, 8 and 110. YTM is, we have already calculated, 1.0535 minus 1, 1.0664 minus 2, 1.0769. Present values 7.59, 7.03, 88.08. And the final market value is 102.7. Now the requirement number 3. The requirement 3 says calculate YTM for cost of capital. Now listen carefully, students, please. And there you have to calculate YTM 2 times because examiner has asked us to calculate YTM on rating AA and triple B as well. Now here I have to use FM IRR approach. Now I cannot use YTM approach for cost of capital. So when the rating is AA, market value of the bond is 103.8. Now listen, student, carefully. YTM for WAC when rating is AA. Simply we have to use IRR shortcut. Examiner has not given us any tax rate, nothing, just he's asking YTM. Okay. Cash flows. If you recall, then we take market value of the bond, which is 103.8. Cash flows, they will be 8, 8 and 110. After that, students, you have to just use IRR shortcut. You will have your answer. Again, you will be calculating YTM when rating is triple B. T1, and this will be outflow. First one. T0, T1, T2, T3. Cash flows. $102.7 outflow. 8, 8 and 110. By using IRR, you will calculate YTM. I hope students, you have understood each and everything, and plus, especially those students, they have attended the previous 2 classes. I want everyone to use the shortcut and calculate the IRR, okay? Plus, I want everyone to solve part 1 on the spreadsheet. If you have any issues while solving the part 1 on the spreadsheet, do mention in the WhatsApp group so that in the coming live revision class, we'll be doing in our live revision class on the spreadsheet so that everyone can see this. Plus, those students, they have attended the previous 2 classes. I hope you might have observed today that today's class was far more longer than the first two live revision classes. And we have covered many things today. So as I mentioned, we'll be having a weekly one live revision class, but the time duration will increase. But now listen, a very important announcement before we end the class. In your portal, there is a one session that is for live revision classes, March 25. And this will be the third class, which which will be uploaded after 2 to 3 hours, inshallah. Plus, in that live revision classes, I'm going to upload a very small video of changes in AFM regarding MM plus tax equation, which you people might have seen. If not, I'm going to upload that video in the live revision class. So please, you have to watch that video as well, which is hardly 10 or 8 minutes longer, not more than that. In the coming class, inshallah, we'll be discussing investment appraisal. But in investment appraisal, we will not be just discussing the concepts. We'll be doing the latest past papers as well. And which question I'm going to discuss in the coming live revision class for investment appraisal, I will share those questions with you, inshallah, by Tuesday. So you will have number of days, plenty of days, so that you can attempt those questions as well. So that is all for today's class. Do give the feedback on today's class in your respective WhatsApp groups. Thank you very much and have a nice life.